First of all, I'd like to thank all of you for coming, for all of you here, all of you watching on TV, and hopefully many of you watching on Facebook as well, where this is, I'm told, live. Mr. Malik, it's live on Facebook, correct? Yeah? On the Ministry of Finance webpage, it's live there too. This is obviously a very important day for all of us in the economic division, and hopefully it's a very important day for all of you as well, because it is a really massive document we've produced this year, and I just want to remind you that this is just the first installment. So this beast has come in the first installment. It's going to be as big in its second installment sometime during the summer. Such a document would just not be possible, of course, without contributions from scores, I would say even hundreds of people this time. If you look at the list of acknowledgements, I hope we haven't excluded anyone, but there have been people from all over the world, private sector, public sector, academia, within India, all over India, who've contributed to this. And I really do want to thank them on behalf of the economic division. Of course, this is the collective product of the staff of the economic division who deserve a lot of gratitude and congratulations. In particular, I want to thank the coordination unit headed by Archana Mathur, and also especially to Mr. Abdul Karim and Anthony Syriac for shepherding the process through the actual physical publication. I want to thank all the members of the Office of CEA who worked very, very hard for a very long time to produce this. There are two people in particular I wish to thank without saying that other people are not important. Everyone's been very important. All chief economic advisors need their own chief economic advisor, and mine is Josh Feldman, and who has really expanded the bandwidth of the division, the Office of CEA, and my own bandwidth. So heartful thanks to Josh. And my last but not least is I think I have to thank my fantastic boss. I call him boss, but he's actually the finance minister of the country. He has not only provided support and space to allow this to happen, but I think he will also have to be a shield for me when the reactions come in from all of you today and tomorrow. None of this, it goes without saying that none of this would be possible without the Honorable Finance Minister, and we're all deeply, deeply indebted to him for all the encouragement, support, and guidance that he's provided. It's a long document. The presentation is going to be a little bit long. I beg your patience, your attention. I hope you'll be rewarded. If I see any of you, your heads dropping, I will start moving quickly. First of all, I want to begin by saying, what should be the aspiration for an economic survey? A lot of stuff has recently been written on the economic survey. What should it be about? And here I can do no better than quote one of the greatest economists of all time, John Maynard Keynes, who said this about economists, but I think it's true about any good survey as well, that it must try and do everything. It must draw upon mathematics, history, philosophy. It must study the present and the past. And very importantly, it must be purposeful and objective, and its authors must be as aloof and incorruptible as artists, yet, like grubby politicians. So we have to try and do everything. And Amitabh Bachchan, I think, says this more colorfully, I think, when he says, "Isme drama hona chahiye, tragedy hona chahiye, comedy hona chahiye, sab kuch hona chahiye." And that's what the survey, I think, tries to do. We've probably fallen short of these lofty standards, but that's what we've tried to do. And that must be the aspiration for all economic surveys. Okay, the structure of the survey, it comes in 4 parts. Just to kind of entice and tease the reader, there's a section called 8 Interesting Facts About India that you probably didn't know. So those who are attention challenged, they can just go to that. But apart from that, there are 3 sections, what we call the perspective, which is a kind of big picture take on the economy, short term and medium term. Then what we call the proximate, all the pressing challenges in the short term, and then the persistent, all of the medium term challenges. Obviously, this is a forward-looking, ideas, analytical-based document. There will be, as I said, a review coming later in the summer. But I do want to emphasize that this is a government document, absolutely, but it also aims to provide objective analysis, and what Keynes said and what the finance minister has kind of provided the space for is to be both purposive but also dispassionate and objective. This is what we try and do. This has a lot of material, 14 chapters, a lot of it with medium-term issues as well. But today, given the constraints of time, I'm going to focus mostly on what are some of the more pressing short-term issues. But I do hope that all of you, after splashing headlines tomorrow, will go back and read some of the other chapters as well. And there is a lot of food for thought here. So today's presentation, I'm going to go review developments. I'm going to talk to you about the near-term outlook, including the impact of demonetization. Identify, discuss the short-term challenges, and then conclude with some medium-term challenges as well. Okay, if you look back on the last year that's gone by, I would say that it's been characterized by robust macroeconomic stability. I'll explain how. There have also been a very impressive set of reform achievements. I will just highlight them. And of course, you cannot ignore 2016 without focusing on what have been absolutely tumultuous external developments. The phrase we use in the survey is that these are developments forebodingly laden with darker possibilities. Darker possibilities of trade tensions, darker possibilities of retreat from globalization around the world, and of course, much more fundamental questioning about how countries should run their economies. And these are mostly happening in advanced economies, but they're going to have their repercussions on India as well. And chapter 1, the overview chapter, has some implications for India as well. Today, I'm going to focus more on the domestic. I think it's fair to say that there's been robust macroeconomic stability in the last 1 year. Headline CPI inflation has come down. If I can get a marker while I'm talking, that would be great. The current account deficit has come down from, it used to be 3.5%, 4% of GDP. It's now less than 0.5%. Reserves are at their all-time high. And I think it's important to emphasize on the external front that last year, 2016, we've survived two major shocks. One, the FCNR redemptions that people now can forget because it went so smoothly. And second, also the volatility from both the US elections and demonetization. I think externally we've weathered that very successfully. And of course, on the fiscal front, it's a story of steady fiscal consolidation and acquisition of acquiring credibility. So, and of course, if you look at FDI inflows, they're at a record high. In the second quarter of last year, it was about 26 billion, all-time high, reflecting how investors perceived the Indian economy. I do want to emphasize here that macroeconomic stability is easy to overlook and become complacent about. But it is absolutely fundamental to anything and everything that any government wants to do and is able to do going forward in terms of meeting the long-run goals of growth, justice, and employment. Just to remind you, you kind of notice macroeconomic situation when you don't have it. And let us, just want to remind you how things felt in July, August 2013, when we did not have macroeconomic stability. We were close to crises. We were clubbed with the fragile five kind of basket case emerging economies. And everything was heading south. Investors were fleeing. And today, as we look back, we've put that considerable distance behind us. And it's easy to overlook that because now we're in a good situation, but we should never take this for granted because macroeconomic stability is the kind of base from which everything else follows. Now, of course, this is a chart on how GDP growth has behaved. You can see that real GDP growth has increased but stabilized. Nominal GDP growth declined last year and has come back up. And I would insist that especially at a time when the CPI and WPI were diverging so much this year and last year, at last it's caught up, nominal GDP growth was an important indicator to monitor. Now, if a year ago, someone had stood in front of you and said that the government within the next 1 year would implement an absolutely landmark GST bill, would secure passage of the bankruptcy law, would codify the institutional arrangements in the form of a monetary policy committee, and would pass the Aadhaar bill. If someone had said that a year ago to you, you'd have probably greeted that with skepticism, quite rightly so. But yet, a year on, I think all these achievements have happened, and legislatively with near unanimous political support. So I think, again, it's something that we kind of tend to forget. We've had, the absolutely, transformational GST, which is going to have all kinds of positive impacts on investment, on tax compliance, on governance, on growth. And of course, it's an absolutely radical experiment in the governance of cooperative federalism, and we're already seeing the benefits from that. The finance minister and, of course, my good friend Hasmukhji were instrumental in doing this, but it's just an absolutely landmark achievement which we should recognize. In addition, FDI was liberalized. I think we've also had this UPI being implemented, which, because of the interoperability that it creates, is going to make JAM a reality, because it's going to make M-Mobile an integral part of JAM. And of course, the government also had taken some important steps to promote the labor-intensive sectors like apparels and made-ups. Now, just as an aside, I would like you to go, see, despite all these achievements, it's very interesting that the ratings agencies have not reflected this. So there is a box in chapter 1 where we show how maybe what kind of inconsistent standards the ratings agencies have. We call this poor standards. Because Standard & Poor's said last year that there's no way we can upgrade India because of its low GDP and fiscal deficit. But actually, if you look at how they have rated China and India, it's absolutely astonishingly inconsistent. China is about 6 grades above us on the ratings, AA minus, BBB minus for India. And yet, since 2008 onwards, 2 absolutely key indicators of risk have, in the case of the indicators being growth and credit growth, China's GDP growth has come down dramatically. Its credit to GDP has risen dramatically, and everyone acknowledges that this is the single biggest risk to not just the Chinese economy, but to the world economy. India's indicators have moved in exactly the opposite directions. And yet, how did the ratings agencies behave? They upgraded China, and they did not, despite all these risky developments, they did not downgrade China, whereas in fact for India, the rating was maintained 6 notches below China. So it's an interesting thing about how, I think, reflection on how these, institutions work, but I think we should question them. But this is just, I think, for all of you to digest and have a little fun on. Now, I've spelt out all the achievements of the government and the economy in the last year. But as I said, we have to be objective about the economy. We have to provide objective analysis, because I think it's only honest and fair to recognize that despite all these, there is a kind of sense of anxiety, a sense of, maybe things not going as well as they should. And our sense is that it stems from 2 things. One, the impact of demonetization. And second, the way investment, credit, and jobs have been behaving, not as strong as they should be. And I think these are 2 very legitimate concerns. And so the economic survey takes them head on. Now, of course, I think the headline should also be that finally the CEA speaks on demonetization. I think there is an old saying that you should only speak when you can improve upon the silence. In this case, I would say you should only speak when you can improve upon the noise, the clamor, and the cacophony, which is what demonetization has been about. So we are going to speak on demonetization. So how should we think about demonetization? It is a radical currency, come governance, come social engineering measure aimed at permanently and punitively raising the costs of illicit and unaccounted transactions, what you call kala dhan or black money. I think at its core, that's what it's about. I mean, you can flesh it out in terms of counterfeit, this, that, and the other, but we're trying to kind of cull out the essence. I think it's also fair to say that the public debate on demonetization has raised three issues. One, the design and implementation of the scheme, and on this, the economic survey is not going to speak about this. I mean, it's in the past, and other people have commented on this. Second, on the costs and benefits, and third, on the broader implications for future economic policy. Now, I think everyone, now I'm going to talk about the costs and benefits. I think it's fair to say that there have been short-term costs which are real and significant. I think there has been hardship and inconvenience imposed, especially those in the informal sector. But there is also the potential for long-term benefits. And in the chapter 3, there's an elaborate discussion of what the potential long-term benefits can be. I think it is likely to increase financial system savings because in equilibrium we expect that cash to GDP and cash deposits should decline. Corruption couldn't be expected to decline. Black money similarly. I think already you see the increase in digitalization of the economy. You can also see early evidence that real estate prices have come down. In the long run, all these measures should improve GDP and tax collection. And of course, a lot of this is also going to depend upon the follow-up actions that will be implemented after demonetization. And I will spell those out a little bit later. Now, I think that it is really, really important to understand, part of the reason one should be a little bit careful and cautious about examining the impact of demonetization, because it is analytically a very, very unique experiment, not just in India, but probably anywhere in the world. Because it is a very unusual monetary experiment, and people haven't grasped what is so distinctive about it. And I think it represents a structural break. No real models exist to kind of model this and say, oh, we know this happened in the past, and we can use that to project the future, because you simply can't. It's something very, very unique. Now, and I am absolutely sure that 5 years from now, there will be 50 to 100 PhDs just on this dimension of India's experiment with demonetization. And what is so unusual? Demonetization actually has affected different forms of money very differently. So in the chart on the left-hand side, we show in red what happened to one form of money, which is bank deposits. And in green, we show what happened to the other form of money, which is cash. What demonetization has done is both simultaneously reduce the supply of cash quite dramatically, but by the same token, it's increased the supply of deposits, because that's how demonetization was structured. So it's affected different forms of money very differently. And on the right-hand side, you can see what the price consequences of that are, because the price of one form of money, demand deposits, G6, etc., have come down quite dramatically. The lending rate has come down by about 90 basis points. The G-Sec rate came down, I think, initially by about 60. It's recovered to some extent. And we know that cash was still in short supply, so we know the price of cash went up. So the supply of cash went down, the supply of deposits went up, the price of deposits came down, and the price of cash went up. So this is a very unusual experiment in monetary history. That is why I think we have to be really cautious about assessing what its impact is going to be. So first, let's turn to the green line, the cash impact. And here, the first piece of, I think, news I want to give you is that the currency squeeze was less severe than commonly perceived. On the left-hand side, you see what everyone thinks was the supply of currency in circulation. On the right-hand side is our estimate of the currency in circulation. They're drawn on the same scales, and what you can see is that the decline on the left-hand side is actually much greater than the decline on the right-hand side. And that's because the headline number on currency in circulation obscures the fact that de facto, a lot of demonetized currency was still legal tender. So if you correct for that and for other things, you find that the headline decline in currency was less severe. For example, on the left-hand side, between November 8th and December, the decline seems to be about 41%. I think we estimate it to be closer to between 30 and 35%. Second point, which goes in the other direction, is psychologically it felt that the currency squeeze was most severe in November, but actually it was most severe in December. And that's also a contrast between the left-hand side and the right-hand side charts. And finally, of course, the most important thing, if you look at the right-hand side chart, is that since end December, I think we're well on our way to remonetization, and in a month or two, we should be close to full remonetization of the economy. And so this is a very important, kind of set of analysis that we have in the demonetization chapter. Okay, now is kind of, what everyone is, what do you think is the GDP impact? And I think analytically, again, thinking about this carefully, cautiously, you can kind of see that demonetization has an effect on aggregate demand. Because remember, if liquidity comes down, the ability to transact will come down. It also affects aggregate supply because in some cases, cash is used as an input to production. I mean, in agriculture, for example, you need cash to pay labor. So if you can't pay cash, you don't have an input to production, and so supply can be affected down the road. And the third impact is that there is genuine uncertainty about how the economy is going to evolve and how policymakers are going to respond, which creates, uncertainty about how consumers are going to make their consumption decision, how firms are going to make their investment decision. Should you consume now or later? How much, et cetera, et cetera. So this is kind of analytically how one should think of the short-term GDP impact. And therefore, in coming up with a number, we have tried to use, as far as possible, indicators that give us a sense of how demonetization has impacted. Here too, there are 2 or 3 complications. One, there's a lot of anecdotal evidence, of course, they went down, this city went up, rail traffic went down, et cetera, et cetera. But for us, the challenge is we need high frequency data. It has to be macro data. It can't be, in Tirupur this happened or in Surat this happened. It has to be macro data. And what people don't realize is that since it happened in November, there's a kind of Diwali contamination. Did it go up or come down? Diwali happened when this year, when last year. It really affects how you, assess the cash impact and the impact on the economy. So what we've tried to do is put together 5 or 6 broad high-frequency macro indicators to see the kind of before-after demonetization effect. And the bottom line is that the evidence is quite mixed. On the one hand, you have wheat sowing, agricultural rabi crop sowing, wheat and gram, which have done way better than last year, than the 5-year average as well. Wheat is up 7%, gram sowing, the main pulse is 10.7%. And so that is up. Of course, we still don't know how production is going to be because it's going to depend upon yields and the access to inputs that farmers have had. But broadly, the agricultural sector, sowing at least, has not been affected. Indirect tax collections, you see a bit of a dip. And now people say, what about, you must do this calculation, taking out the effect of all the new revenue measures that were taken. We've done that as well. What you see is that whatever decline there is has been happening for some time in the excise because the effect of the new tax measures have been coming down. And you don't see a particular blip down or any significant blip after November 8th. Real estate, on the other hand, you do see a dip in prices, in sales, in launches. And of course, some of it may be adverse for the economy, but in the long run, some of that is also good, because in equilibrium, the aim of demonetization is, in fact, to bring down real estate prices. Bank credit, on the other hand, on the other extreme, has been affected by demonetization. It seems like it's come down. And the most affected sector has been especially two-wheelers, where reflecting, I think, the demand from the less affluent and from rural India, demand has come down. So the overall picture is mixed. I think one should tentatively conclude that there will be an impact on GDP. The question is, how much? And so this is our real GDP outlook for the year. For 2016, we expect real GDP growth to slow down by about 1/4 to 1/2 percentage point relative to the baseline. I think it's also fair to say that given the way GDP is measured in India, recorded GDP will underestimate the impact on the informal sector. So these are now. Now, I want to sound a notice of warning to all of you. These numbers will be misinterpreted, will be mischievously interpreted, and so let me clarify how you should not report these tomorrow morning. One, it is not appropriate to do a before-after comparison. Many people will say 2015-16 growth was 7.6, 2016-17 is Y. The difference between 7.6 and Y is the demonetization impact. Incorrect. The more appropriate way to do it is to do what would have happened in 2016-17 without demonetization and with demonetization. And that baseline is really the CSO's advance estimate, where they clearly said it was a without demonetization impact, which is also the survey's impact of the baseline, which is around 7%. And please, 7.15, 7.185, these are all, kind of misleading, spurious accuracy and exactitude, because there's so much noise in the data that you must think, in kind of whole numbers. So first, no before-after comparison. It's a with and without baseline comparison. Second, it is not appropriate to compare the levels of other forecasts with the levels of the forecast made in the economic survey. Why? For example, the IMF has come down to 6.6, but it was originally projecting 7.6 without demonetization. So that is a 1 percentage point decline, whereas we are projecting about 1/4 to 1/2 percentage point decline. So it's more appropriate to compare changes in other forecasts and those of the survey. I do not want to be held responsible for the over-optimism and the incorrect projection by the IMF. We are doing it relative to our baseline. We cannot do it relative to the baseline. It turns out to be an over-optimistic baseline by the IMF. Third, I think it's also not appropriate to compare one number of any other institution with the range provided by the survey, because by definition, when they produce one number, it says, we think most likely this is going to happen. Whereas what we are saying by providing a range is that essentially what you cannot rule out with any degree of confidence. So the 1/4 to 1/2 percentage point decline is relative to our baseline. It reflects the uncertainty in the process. And also it says that, this is what we are comfortable with, not that we think it'll be definitely at the higher end of the range or at the lower end of the range. That is the way. So I'm going to read what each of you is writing up tomorrow, and then I'm going to come back and hold you to task if you deviate from my sermon just now. Okay, but remember that, as I said, demonetization has short-term costs, potential long-term benefits, and really what is now critical looking ahead is what are the follow-up actions to minimize the costs and maximize the benefits. I think this is where the focus should be. I think there should be a fast remonetization, and the earlier that we withdraw the limits on cash, the better. I think the impetus to digitalization that the government has provided must be continued, but I think that one must be careful here. The transition must be gradual. It must be inclusive, because there are lots of people who are not digitally connected. I think we must be very mindful of them. I have a preference mostly for doing this via incentives rather than controls, not dictating outcomes. And I think at every stage we have to balance the costs and benefits of cash versus digitalization. I mean, I think we should remember that digitalization offers a lot of benefits, but it can also have costs because the poor especially don't have as much access. And similarly, I think cash, while a lot of it is prone to misuse, it also has certain conveniences which we must recognize. I think it's really critical. I've said this time and time again, and I'm saying this also because Hasmukhji is here. I think an absolutely natural follow-up to GST is to bring land and real estate into the fold of the GST, which will just, that one source of Kala Dhan, black money, which is real estate, bringing that into the GST with all the self-compliance that happens would be a huge benefit. In the same spirit, reducing taxes and stamp duties. And of course, we need to have a clear, stable, non-discretionary tax administration to allay any fears people might have in the aftermath of demonetization. Okay, what is the outlook for next year? Given the range we've given this year, I think we expect it to be in the 6.75%, 7.5% range for next year. I think the pickup, I think, as I said, the effect on GDP will be temporary. I think as remonetization happens, the economy will recover back to trend next year. And I think that two potential boosts to growth next year, which will lift growth next year. One, of course, is the catch-up from demonetization. To the extent that consumption has been held back, investment has been held back, credit has not been enough, cash has not been enough. As they ease going forward, I think the economy, the kind of grease that's provided and the consumption that happens should pick up again. And I think that one perhaps important source of demand next year could be the export revival from rising world GDP growth with possible spillovers to investment. As you know, the IMF has forecast that next year growth will be higher in 2017 than in 2016. And already we see some early signs of a pickup in growth. The chart on the left shows in the last few quarters, non-oil export volume from negative territory is now in positive territory. And even in our services exports, you can see the glimmer of hope on the extreme right, where finally volumes, in dollar terms, IT services are going to pick up. And especially if the world economy picks up, in the short run, that's expected because of actions in the United States especially. I think that catch-up in consumption as remonetization happens, a pickup in exports is something that can get the economy back to trend next year. How is our attention level, collective attention level? Good? Excellent. Okay, that's good. Because I'm getting now kind of warmed up a little bit here. Okay, remember that we promised that we'd be honest and objective. We gave you what all the achievements were, and we said that there were two challenges. One is the anxiety about demonetization, which I've just addressed. The second, of course, is the anxiety about what we would call the festering twin balance sheet problem. The balance sheets of corporates and the balance sheets of banks are still challenged. We do see evidence of that. You can see the NPAs as a percentage of loans is high and rising, especially in the public sector banks. As a result, overall investment and private investment are now in growth terms in negative territory. That is worrisome. That is a challenge. And of course, reflecting that, you see bank credit growth. This is in real terms. You see two things interesting here. Real credit to the corporate sector to industry is in negative terms, and that's the green line at the bottom. But you see that personal loans, which supports consumption, is actually in robust double-digit territory. And in a sense, the economy has been kept up because of consumption and because of the government, and it's been a familiar story over the last 2-3 years. So all those who say that there is no story to support what's happening in India in terms of growth, I think there is a story. I mean, the consumption and government have been the drivers of growth, and investment and exports and credit have lagged behind. And I think that rectifying that balance is going to be very important. I think that, therefore, addressing the twin balance sheet problem is critical. I want to kind of hone in on what I think is really, what are the distinctive features of these, of the twin balance sheet problems. It's not just about the banks. It's actually now much more about the companies, especially the over-indebted companies. It is an economic problem, not just a morality play. I think mistakes were made, which I think we need to come to grips with. By the way, I should emphasize that this is really, in large part, a legacy issue coming down from the boom years around the global financial crisis. The third thing to realize is that much of this stress debt is in large companies. Many of these companies are unviable at current levels of debt, which will require writing down debt in many cases. Banks are finding very difficult to do this on their own because they're all decentralized, they can't coordinate. And also it's very difficult to take political decisions to say, let's write off the debt of some very big company because you know what the consequences are going to be. It's also worth repeating that delay is costly. And therefore, in a sense, many of the current solutions have not really delivered so far. So one of the things we say in chapter 4 of the survey is perhaps it's time to consider a new solution, something like a public sector asset reconstruction company. But that's just one solution. But the point is that it's a very tricky, intractable, difficult problem. It's been there for a very long time. Current solutions, such as they are, have not really worked. And we have to try and remedy that, and we have to look for new solutions. Now, what are the risks and challenges to the outlook? I think on the domestic front, there's certainly, if there's any lingering uncertainty from demonetization, they need to be addressed. I think on the external side, I can think of three sources of risk. I think oil prices could go higher. Of course, subject to a cap of about 65, because at about 65 or so, shale oil production comes on. So there is a natural kind of lid on oil prices, but I don't think we want to get to that and to test that, because as oil prices rise, our macro fiscal inflation do get more difficult, and I think that can challenge us. I think the other big risk is escalating trade tensions. I think, China is still, with a lot of underlying vulnerabilities, a source of systemic risk. There could be trade tensions, and of course there could be a resurgence of protectionism. All of these will affect the outlook and our risks to the downside of our outlook. The upside potential, of course, is that, if the world economy in the short run picks up, and exports continue the trend that I showed you, then it's possible that the outlook could be better than what we've projected so far. Now, I have only covered so far probably 3 or 4 of the 14 chapters. I am not going to cover the remaining 10 because I'm sure I will lose you by then. But I do want to cover one. But before I do that, I also want to say that there are many more chapters in terms of what we need to do for the textiles and leather sector. How should we think about fiscal policy at the center and the states? How should we think about, is there a natural resource curse in India? Is there an aid curse in India? How should future finance commissions treat transfers going forward? What do we think about, whether India is one market? I think there's some very exciting new research on the fact that India is a new market. You'll see a piece tomorrow on that. We've done some really, here I'm being immodest on behalf of my colleagues. We've done some absolutely cutting state-of-the-art research to actually puncture all perceptions about how India is a kind of barrier-riddled economy. Trade within India is very, very high. People moving in India is so much higher than people think. About 9 million migrants move across India for work today. It's almost double what people think they are. So there's a lot of research out there that I would love for you to go and read. But I do want to focus on one other medium-term issue, which is that everyone and his uncle has a view on this. So do we. But I think they have a view because they think we're going to come out with a view, which I'm going to give it to you now, which is universal basic income. And the chapter is written up, I hope you'll go and read it, as a conversation that Mahatma Gandhi might have had, that you could have had with Mahatma Gandhi, or that he might have had with himself. I actually presented this on October 2nd at Sabarmati Ashram, where I was invited to come and speak. And he would have been genuinely conflicted by the idea. I mean, so it's not that he would have bought into this. And the chapter, in a sense, gives a sense of that, pros and cons. I think UBI, first of all, is a very simple idea. It's based on 3 principles: universality, everyone gets it; unconditionality, you don't have to do anything to get it; and agency. You don't get it in any particular form, like, only if you get it in terms of cash, in terms of food, in terms of government buildings, etc. You get it, as cash. Now, the key merit of this is that it has the big potential to improve upon weak targeting of current schemes. And here, again, my team have done some new and really excellent research, which kind of is captured in these 2 charts. So the map on the left shows where do you see the most poor in India, and that's the red. So red is a lot of poor, green is very few poor, and the right-hand side shows what is the shortfall of spending in government programs that goes to those districts. And you see that the color pattern on the right-hand side is very similar to the pattern on the left-hand side, which basically is saying that, wherever there are more poor is precisely where you have a shortfall in spending. And our rough calculation is that, based on analyzing 6 programs, but also looking at the past, in those districts which account for 40% of the poor, only 29% of overall spending goes there, which means essentially it is intrinsic to government programs in India that they will exclude the needy, the poor, because the take-up of these programs will be best in those states that are better governed, which by definition have the fewest poor. So that's intrinsic to this. It's not, you shouldn't point fingers at anyone and say, this was badly run, this was well run. It is intrinsic to programs. You run a PDS, it will run better in, state A versus state B, and you pick your A and B. The advantage of UBI is that it can get around this. Universality means we can give it to everyone from top down. We can skirt these layers of bureaucracy in between. And that's one of the virtues. We estimate the fiscal cost about 4 to 5% of GDP. We give a sense of what are the other current subsidies to middle class, fertilizers, about 2 to 3% of GDP. And, as I said, there are big implementation challenges. And the biggest one, of course, is that, we know in India that if you create a new program, it will become an add-on to an existing program and therefore will become fiscally unaffordable. And that's a challenge which, we have to grapple with, we have to think about. So what we say is the principle should be de jure universality, but de facto quasi-universality, i.e. you try and exclude the very rich and those who are obviously not in need of this money. We also think it should be done in a gradual manner. It should, respect choice. It should lead to replacement of existing programs. And the prerequisites, of course, to have a functioning Jan Dhan system. And I think it would help if the center and the states could cooperate on this program. But I want to end on this UBI. I think it's a very radical new idea. But again, please do not misreport the survey as saying that the survey is advocating UBI. What the survey is saying is it's a very new, compelling idea. It has a lot of challenges. So it's an idea whose time is ripe for further deliberation and discussion, and not necessarily for immediate implementation. So again, that's where we come out. Now, finally, I also said I'll deal with the medium-term challenges. I think if you step back and look at India for the last 25, 30 years, and see where have we come in terms of our underlying vision of the economy. And I think the broad understanding is that, oh, between 1947 and 1991, we were socialist. After that, we've abandoned socialism, and that's where we are. I think that's in some part true, but it's a little bit of a caricature. But I think it's interesting to take stock of where we are. I think if you look at, some of the broad parameters of the Indian economy, by the way, we're an economy today that's more open to trade than China. This was astonishing news to me when I first saw this about 2-3 weeks ago. On the first chart, you compare the trade to GDP of India and China, and you can see the red line, India is now above China. So India is a bigger trader, more open in that sense than China. In terms of capital, openness to capital flows, we're middle of the pack. In terms of a very big public sector, I think we're big, but not much bigger than many other countries. The chart on the right shows that we're in the middle in terms of public sector assets. And even in terms of government spending, which is the third chart there, we're kind of in the middle of the pack. So if you step back and say, is this a protected economy? Is this a socialist economy? I think we've come a long way. We're open to trade. We're open to capital. Government is not necessarily very intrusive. And the bottom chart shows that for a democracy over 35 years, we've actually done very, very well, probably amongst the fastest growing democracies in the last 4 or 5 years. And yet, I think 3 what we would call meta challenges remain. Meta meaning in some ways much deeper and more profound than anything else. In chapter 2 of the survey, which I would urge you to read, the chapter is called The Economic Vision for a Precocious Cleavaged India. We think there are 3 fundamental problems, meta challenges. Inefficient redistribution, I gave you a sense of that. There's still a certain ambivalence about the private sector and property rights. And I think state capacity still needs to improve considerably to kind of especially deliver essential services like health and education. I think the states on their delivery of health and education have not made as much progress as they should. I don't even think there's a dynamic in India, the competition between states dynamic, which is very powerful when it comes to attracting investment, talent, boosting FDI. That competitive kind of juice between the states is not flowing in terms of, my state delivered a better health system and that becomes a model for everyone. I think that's a challenge. We give several examples of what these mean, and I think that's where I think if we want to go from, say, 7.5 to 9 and 10, I think in some ways many of these challenges will have to be overcome. So I think let me conclude by saying that a robust macroeconomy, important reforms, especially the transformational GST, the short-term. I've been through the anxieties about demonetization. I do think there's a short-term challenge about how to revive private investment credit and exports in order to boost employment creation, because as we all know that with India's demographic dividend, I think the central challenge is job creation. And then, of course, there's also the medium-term challenge. And I always like to end with a quote from the survey, which I want to read out. Looking further ahead, societal shifts. I think that overcoming these meta challenges, it's not about vested interest per se or political will, et cetera, all the normal things that you think about. I think we require deeper societal shifts in ideas and narratives to overcome these meta challenges. In the aftermath of demonetization, and especially at a time of gathering gloom about globalization, articulating and embracing these ideational shifts will be critical to ensure that India's sweet spot is enduring, not evanescent. Thank you very much.